Hi everyone, this is Pauline. Last night during the webinar, we actually received many questions from the participants, but due to the technical glitch, we have to cut short the Q&A session as such, right? Today, we have invited Jeremy again to produce this special edition for all of you. All right, so without further ado, let us begin the Q&A session. Before we proceed further, I would like to highlight the disclaimer to everyone. Whatever counters that we mentioned during the presentation as well as during the Q&A session later is not a solicitation, not a recommendation, not a buy call or sell call. All right, so for any counters that you are interested in, you have to do your independent evaluation. Whatever is presented by the speaker and what we have discussed later on is purely our analyst point of view. All right, so without further ado, let us proceed on. Okay, the first question that we have here is, Jeremy, are you there?
Yeah.
Yeah. Could you tell us more about USO or UCO back there during the oil crisis, where USO ETF went all the way down to negative interest rate, and how can investors stay cautious and avoid getting hit?
Yeah, so I guess back then what happened was we saw oil prices kind of crumbling into negative territory. But more so, we're talking about the front end oil futures that actually dived down to, if I can remember correctly, down to around negative $40 per barrel. So that was actually what was happening within the futures market. But again, during the webinar that we had last night, when we talked about ETF, there's actually two portion of ETF, one that is synthetically backed ETF and one that is physically backed ETF. So what USO and UCO is actually, they are a kind of a synthetic ETF whereby they actually invest in derivatives. So what is within the basket for USO and UCO is actually futures contract on a different maturity, different curve of the oil futures contract. And henceforth, during the period of sell-off that we saw in, I think, March, where oil prices actually fell to negative $40 in the front end March futures contract, that actually dragged down the ETF performance for both USO as well as UCO. And henceforth, that's why we actually saw that negative move. And in terms of how investors should actually stay cautious and avoid getting hit, again, I think going back to what the underlying fundamental of ETF is, you firstly need to know what you're investing in, whether it's actually a synthetic ETF. And if it's actually a synthetic ETF, what is actually the core holding within the ETF itself. So again, for this case, this USO and UCO, they are actually backed by futures contract on oil futures. And henceforth, there is the risk of oil prices going to negative, and that's why we actually saw the ETF falling into negative territory.
Yeah, thank you. Next question, is there a suggested minimum number of stocks that an ETF should be tracking to consider a good diversification? Is more always the better?
I would say, at least based on some theoretical studies that have been done by professors and universities, the magic number is somewhere around 25 to 30 stocks. So anything more than 25 to 30 stocks kind of will give you the best or the way that you can actually minimize your idiosyncratic risk to the maximum level. And anything more than that basically don't really offers you that much of a diversification risk and getting you out away from the idiosyncratic risk perspective. But then again, in terms of is having more always better, it depends on what your investment objective is, because if you were to compare just basically two broad groups that I can easily think of it, for example, the S&P 500 index, we have 500 stocks in there that spans across 24 industry groups, pretty much diversified. But again, with that diversification comes slightly lower returns because it's not so much concentrated as compared to, say, NASDAQ 100, which is mainly focused within the tech sector with only 100 stocks. Which is why we get slightly better return during a pro-cyclical kind of economy as compared to what we are seeing within a more broad-based S&P 500 index.
Sure. Okay, next question. What's your view on the biotechnology ETF?
I guess right now there might be some interest within the biotech space. Mainly, if I can think of it, the ticker code that is popular right now in the US is called IBB, basically a biotech ETF. But I guess right now the interest stems from the COVID-19 pandemic situation, whereby many of these pharmaceutical companies as well as these biotech companies are coming up with a possibility of seeing a vaccine. So that could actually be a short-term play here, whereby getting into this biotech ETF, you can actually gain an exposure and riding out some possibility of us seeing a vaccine even earlier by end of this year. So probably it could be treated as a trade within a time span of at least 3 to 6 months until we get a vaccine. But in terms of a long-term holding, I wouldn't really have much of a view going more than 6 months out after we get a vaccine. So yeah.
Sure. Okay, next question. What's your view on green bonds then? Green bonds ETF.
I guess that is something that the market is getting interested in, especially when we are talking about moving into clean energy, moving into environmental sustainability kind of a new world. But then again, in terms of it gaining traction as more of a mainstream view, I think it will still take some time for the adoption to come, because it's still something that's relatively new, and I guess it's still an industry that is still pretty small. So yeah, that's I don't really have much to add other than that.
Sure, thank you. Okay, how is PE ratio of an ETF being defined when evaluating whether the ETF is at the fair value? Because
I
I
guess
think usually,
based on, if I would address the first part of question, calculation of the PE for an ETF is basically the same way as how you calculate a PE for individual stock. So for the ETF, how the PE is being calculated is you firstly need to find the total market cap of the basket of stocks that you're holding, and then after which find the earnings per share of each individual stock and adding them up, and then henceforth you get the PE ratio from both components. And then in terms of evaluating whether it's actually at a fair value, I guess the easiest way is to look at the historical performance of the ETF that you're investing in, and then looking at the historical value, where we are within the band. Are we above the 5-year, 10-year average, or are we below the 5-year or 10-year average? And then with that, you'll get a better understanding as to where you are in terms of the valuation side of things. And that will give you a better sensing rather than just looking at a static number.
Sure. Okay, are ETF more suitable for investors or traders? Can trader also trade ETF?
I guess it kind of fits for both spectrum. For more of a long-term investment, passive investing, I guess the easier way to employ ETF is to get into a passive index such as the S&P 500 index, the SPY, the QQQ, so on and so forth. Buy and hold, park there, and hoping that historical returns will stay true of annualized return of 8 to 10%. So that kind of investment will be suitable for investors. But as for traders, there are actually more ETFs out there that actually also cater towards the trading side of things, whereby you're talking about 3 times leverage, 2 times leverage product, where they actually amplify your return on the individual index itself by 2 to 3 times. So those are the ETF that I would say is more suitable for traders that want to be in and out of a trade in a day itself. That will offer you better leverage, better return, but also at the same time, the warning is definitely a higher risk.
Sure. I think you have also covered the next question already about telling us more about LNI ETF.
Yeah,
So
kind of.
let's move on to the next one. Then what is the difference between trading a put structured warrants or a put options and buying an inverse ETF?
There's actually quite a big difference here. So let's just address the first part, put structured warrant or put option first.
Sure.
So for put option or put warrants, the main highlight is there's actually a time expiry to it. There's actually an exercise price to it. So you are being defined by actually a time horizon as well as a strike price that you actually place. Whereas if you are buying an inverse ETF, you are actually susceptible to the day-to-day movement of that particular index that you're tracking. So in terms of trading flexibility wise, I would say inverse ETF will give you a better flexibility because it doesn't constrain you to a time frame. And at the same time, you have the free rein to actually choose when to take profit or when to kind of close your trade at a predefined stop loss. And there isn't really a kind of a strike price that you are being constrained to. So ETF does actually still give you, I would say, more flexibility in terms of controlling the trade that you are taking on rather than being in a put option or put warrant as a comparison.
Sure, thank you. Next question. What will happen if one or more of the underlying stocks of an ETF is delisted? How would it affect the ETF?
Usually when that happens, either two things can happen. The weightage of the rest of the stock will kind of move and flowing into the full portion of the ETF sizing, or new stocks will be added into the ETF basket to fit in the full weightage of the 100% for the ETF. But usually for ETF or the stocks that get delisted in an ETF, it's actually not that of a common thing, because most of the stocks that are usually within an index ETF or index fund, usually they are highly liquid, highly tradable, and usually they are the top 100, top 500 stocks within a certain jurisdiction. So usually that won't happen. But when that happens, like I mentioned, usually new stocks will come in, or they will just increase the weightage of whatever underlying stocks that it has within the basket.
Sure. Okay, next question. Which platform can we buy ARK ETF?
So
I think our own
yeah,
platform can do that, right?
most platform
Yeah.
you can actually trade this ETF, and then maybe just adding a bit more. ARK ETF is actually listed on the New York Stock Exchange, NYSE. So yeah, basically most platform out there offers you the option to actually trade this particular ETF.
Right. Okay, next question. Any investors, any ETF investors can consider going forward?
Maybe I would say for those that are new to investing, or for those that don't really have the time to actually go through their due diligence, doing a homework for stock picking, I guess the easiest recommendation is to look at SPY, which is the S&P 500 Index ETF, which I've mentioned quite a bit last night. Just think of that ETF as a long-term savings plan, whereby you just park your money there, hold it for 5 to 10 years. At least historically, what has been proven true is it does actually offer you a better return, annualized return of anywhere between 8 to 10% in the long run. And I would say it's definitely better than parking your money in the bank, where fixed D pays you anything less than 2%. So just think of it at least from that perspective, and then maybe moving forward, if you'd like to explore more, you can actually do your own homework and study more from then on.
Sure, thank you. Okay, next question. Do ETF pay dividend? If yes, how often?
Yeah, so I think we addressed this last night a little bit. So again, just to explain more, depending on the ETF that you're investing in, usually most equity-based ETF would actually pay you a dividend. So for instance, SPY pays you semi-annual dividend, if I believe, in January and in July. So again, it depends on the ETF that you're buying in. And then also there are other types of ETF that doesn't pay dividends, such as a GLD. So again, the bottom line is depends on what you're buying.
Sure. Okay, next up. Do foreigners who invested in US ETF need to pay tax on capital gains and dividends received? If yes, what is the percentage? Do you by any chance aware of this?
Yeah, so at least for foreigners, capital gain tax isn't involved here. It only revolves around US citizens. So capital gain tax, definitely we are not subjected to. But as for dividend tax, yes, I believe we are being taxed at a rate of around 30%, if I'm not wrong, for dividend that we are receiving.
Okay. Okay, next question. What is the difference between an active and a passive ETF? Is UP ETF an active ETF?
Yeah, so again, two broad groups of ETF. One that is passive, which is most of the ETF out there, which basically just tracks an index that is being formed by an index provider. So for instance, again, the go-to name is the S&P 500 Index. That is an index alone. And again, like I mentioned, investors don't really have a direct way to buy into the index. the easiest way is to buy through an ETF that tracks the index. So that usually forms a passive tracking ETF over here. And then as to active ETF, ARK is actually an active ETF that don't really track an index. So what happens is there's actually an active manager, fund manager that is behind the portfolio, the ETF that it's holding. And basically it's like a hedge fund or active fund that is actually having a deliberate move in terms of choosing where to invest in terms of overweighting, underweighting any stock over there. So active investing of ETF does actually cost you a little bit more because of that overweighing, underweighing of different stocks within the portfolio.
Sure. Okay, next question. With the current situation where equities, bonds, and gold seem to be rising in sync, is this the right time to build a 60-20-20 portfolio?
Yeah, I guess that's a good question. So if you were to look back in history, this current movement within the equities, within the bond side, within gold itself, it's pretty similar to what we saw actually in 2002 after we came out from the dot-com bust, all the way to 2007. So during that period from 02 to 07, we actually saw these three asset classes kind of moving in tandem to the upside. And that is also similar to what we have been seeing over the past 6 months. So at least from a return profile perspective, it does actually tell you that right now seems to be a good time to be invested or kind of aligned within this 60-20-20 portfolio. And even if that correlation does break down, again, like I've shown, the long-term perception that we want to have here is the negative movement within the equity market would actually be offset by the positive movement within the bonds as well as the gold side of things. So regardless of the situation, I believe the 60-20-20 portfolio does still offer a better optimized kind of a balanced portfolio scenario.
Sure. Okay, next question. Could you tell us whether the simulated portfolio shown on your presentation that last night, right? Is it before or after cost?
That is actually before cost, because I think Bloomberg doesn't really allow that calculation of the expense ratio. So yeah, so it's before cost.
Sure. Okay, next, could you tell us about how the management fee for ETF works?
So all the fees that you actually see will be tabulated under the key thing to look out for, which is the expense ratio. So again, expense ratio usually range from around 0.1% to around 0.7%. And what it is basically the management fee, whatever fee that's being incurred from the fund management side, that's being deducted from the NAV of the ETF on an annual basis. But then again, when you are actually buying into an ETF, whatever expense ratio has already been calculated within the price that you're paying for. So it won't be deducted elsewhere within the trading account. Everything that you paid for within the ETF price that you see there is already accounted for the expense ratio and the management fee.
Okay, next question. Is there a REIT ETF listed on the Singapore Exchange?
I believe there is a handful. I believe there is three or four. Lion Philippe Global ETF, as well as I believe 2 more, which I can't think of it. But if you like to, I think, search for more, you can just simply Google REIT ETF in Singapore. I believe there is 3 or 4 that you can actually invest in.
Sure, thank you. Okay, one last question. Based on your presentation, right, it is noted that when you compare the past performance of the ETF against the benchmark, is about at least 10 years of the performance record. So in this regard, what is your take for retail investors who owns an ETF that has rallied for 30% within a year? Will you suggest them to take profit or to continue holding the ETF?
First thing first, I believe we need to know like what ETF is talking about, because dependent on the strategy that I'm employing, be it within the broad-based market or even like the ARK ETF that I talked about, where you have very different spectrum of return, spanning across like outperforming 100% to S&P being up just like 10%. That is required to know first before actually taking the next action, whether you should be taking profit or continuing to hold. And then I guess the other side of things is whether you are investing for the long-term kind of perception whereby you are parking your money there and thinking holding it for long term, like what we have with the SPY annualized return of 10%. If that is the idea, then I believe you shouldn't really be doing that much of active management for the portfolio, because at the end of the day, the goal for your investment is a long-term holding, long-term savings, and that 30% return that you're seeing right now could actually continue on for the next, I think, 5 to 10 years in between with some sort of a drawdown. That doesn't really matter that much, but at the end of the day, it's the long-term plan of savings and probably hoping to get an annualized return of around 8 to 10% over a horizon of more than 10 years. So again, to sum it up, I think it depends on your investment mandate, your investment objective. Are you a trader or are you an investor?
Sure. Thank you, Jeremy, for taking the time to do this special edition with us. Thanks, Jeremy.
Yeah, no worries.
So with that, right, we will end off the session for today. Again, we would like to remind everyone, for those who are interested, we have 2 more parts to the ETF series, part 2 and 3. That falls on the 24th of September and 1st of October. For those who are interested, please remember to register your slot by scanning the QR code that you see on the screen. Right? So with that, thank you everyone for watching this special episode, and wish you have a nice day and happy trading with us. Thank you.
Thank you.
Thank you.